Welcome. Have you ever wanted to look past all the hype and see what's really going on inside a company? Well, today we're going to crack that code by learning how to read the story that their financial statements are telling us.
So let's start with a big question. How does a business actually know if it's winning? I mean, it might look busy, its products might be popular, but are those the real signs of a healthy company?
Because, true success isn't just about one thing, like having a pile of cash in the bank. That's only a single chapter. To really know if a company is winning, you have to read the entire book, the whole financial picture.
And you know what? The best way to learn this stuff is to just build it from scratch. So in this explainer, we're going to build the financial story of a brand new company, one single transaction at a time.
Okay, let's get into it. Our company for this journey is a new retail business called Al-Shark Company. We're going to follow them right from day one of their very first year in business.
So to get the ball rolling, Al-Shark has to raise some money, right? They get capital from their owners, and they take out a loan from the bank. And they don't just let that cash sit around. As you can see from their opening records, they immediately put that money to work, buying all the essential stuff they need to operate, warehouses, equipment, and of course, the products are actually going to sell. This is square one.
Now, before we track anything else, we need to understand the single most important rule in all of accounting. This is kind of the magic trick that makes everything work and stay perfectly in balance.
It's called the double entry system. And it sounds fancy, but all it really means is that for every single action in a business, there's an equal and opposite reaction somewhere else in the financial records. Every transaction has two sides. That's what ensures the story is always complete and always balanced.
The golden rule is this. For every debit, there must be a corresponding credit. Just think of it like an old school balancing scale. If you put a weight on one side, you have to add the exact same weight to the other to keep it level. Let's see this in action.
Okay, let's walk through a simple transaction. Let's say Al-Shark makes its first big cash sale for $80 million. The first part is pretty obvious. The company's cash goes up. And in accounting, when an asset like cash increases, we record that as a debit. So, boom, that's the weight on one side of our scale. Now for the other side of the scale. To keep things balanced, we have to ask a simple question. Where did that $80 million in cash come from? It came from sales revenue. And an increase in revenue is recorded as a credit. So there it is, an $80 million debit to cash and an $80 million credit to sales revenue. The scale is perfectly balanced.
Okay, so what happens after a whole year of these transactions? Well, all those little debits and credits get summarized into a few key reports. And the first one gives us a snapshot of the company's financial health at one specific moment in time.
You see, the balance sheet is built on this one really powerful equation. Assets equals liabilities plus equity. This is the accounting equation, and it must always, and I mean always, be in balance, no exceptions.
So let's quickly break that down. Assets are just all the valuable stuff the company owns. Cash, inventory, buildings. Liabilities are what the company owes to other people, like bank loans or unpaid bills. And equity, well, that's what's left over for the owners. It's simply what you own minus what you owe.
And here it is. This is Al-Shark's balance sheet at the end of its first year. After adding up hundreds of transactions, the company's total assets are $935 million. And on the other side of the equation, its total liabilities and equity also add up to, you guessed it, exactly $935 million. The equation holds true. This is like a photograph of the company's finances on the very last day of the year. But a single snapshot only tells you so much, right? It doesn't tell us how the company actually performed during the year. For that part of the story, we need our second key report, the income statement. The income statement tells the story of profitability, and it's a really simple logical flow. You start with your total sales revenue at the top, then you subtract the direct cost of those sales to get your gross profit. After that, you subtract all the other expenses of running the business, and you arrive at that famous bottom line, the net profit. And here is the final story for Al-Shark. Their income statement shows they generated $200 million in sales. After you account for all the costs and all the expenses, they were left with a final net profit of $70 million. So, what does this tell us? It tells us that over the course of its very first year, Al-Shark was a profitable company.
So, let's put all this together. How do these different pieces connect to give us that full, clear picture of the company's real health?
Well, it all starts with the small stuff. Every single action, every sale they make, every salary they pay, every piece of inventory they buy, it's all captured and perfectly balanced using that double entry system.
And then all those little transactions get rolled up into our two key reports. And here's the best way to think about them. The income statement is like a video of the company's entire year. It shows all the action and performance. The balance sheet, on the other hand, is like a single photograph taken on the very last day of that year, showing exactly where everything stood at that one moment in time.
So, if you remember nothing else from this, remember these three things. 1, every transaction has two sides. That's the double entry system. 2, the balance sheet is a snapshot in time of what a company owns and owes. And 3, the income statement is the story of how profitable a company was over a period of time.
With these tools, you can now look at pretty much any company, from your local coffee shop to a global tech giant, and really understand the story of its financial health. So the only question left is, which company's story are you going to read first?